The modern global financial system moves over $100 trillion a day. It operates on a vast network of borrowed money, with institutions using layers of debt to leverage their bets on future price movements. For the world's 1.9 billion Muslims, participating in this network presents a direct conflict. Islamic commercial jurisprudence explicitly forbids the core mechanics of debt-based leverage. The legal framework is defined by three absolute prohibitions. Riba, or interest, is banned because money itself cannot generate money. Gharar, or excessive uncertainty, prevents contracts with hidden risks. And Maisar, gambling or zero-sum speculation, outlaws bets where one party's gain requires another's loss. Transactions must instead be grounded in qabt. This is the requirement of possession. You must have actual or legally recognized constructive possession of a tangible asset before you are permitted to trade it. Integrating these rules into a high-frequency digital stock market requires stripping the global system down to its studs and mathematically restructuring how we define and transfer wealth. Building a compliant portfolio starts with the qualitative screen. You eliminate companies dealing in weapons, the production of alcohol, casinos and gambling, or conventional banking. Next is the quantitative screen, governed by AAOIFI standards. A company cannot carry an excessive debt load. Its interest-bearing debt must not exceed 30% of its market capitalization. But market capitalization changes every second. If a company's stock price drops, its total market cap shrinks. This creates a binary cliff edge. A 29.9% debt ratio is perfectly compliant, but if a minor dip pushes that ratio to 30.1%, it fails the screen entirely. Investors are often forced to sell off assets and churn their portfolios, simply because the daily stock price fluctuated. Once a stock passes the screen, the method of execution matters. Standard spot trading is allowed because there is an immediate, transparent exchange of value and ownership. Margin trading is strictly prohibited. It relies on borrowing funds from a broker to amplify purchasing power, which accrues interest charges. In short selling, a trader borrows shares they don't own, sells them on the open market, and hopes to buy them back cheaper later. This directly violates the prophetic injunction against the sale of non-existent or unpossessed assets. You cannot sell what you do not have title to. Without the anchor of qabt, or true possession, a trade becomes a prohibited wager. Even compliant companies often hold large cash reserves in interest-bearing bank accounts. When that company pays out a dividend, a small fraction contains prohibited interest income. This chart shows how corporate earnings are allocated. The traditional dividend-based method applies the non-permissible percentage only to the dividend paid to the shareholder, but dividends are often just a tiny slice of total net earnings. The rest is retained by the company to fund growth, leaving the majority of interest income unpurified. If the corporate board decides not to issue a dividend that year, the purging amount drops to zero. The interest-based earnings remain completely untouched. The modified AOIFI method corrects this loophole. It calculates the impure income generated per share, prorated to the exact days the investor held the stock. That exact amount is then extracted and donated to charity. This exact purification removes the spiritual taint of the market's reliance on interest, isolating the investor. At the macro level, massive multinational Islamic banks operate across borders. They face immense structural risks from fluctuating currency exchange rates and shifting profit margins. Conventional institutions manage variables using speculative derivatives like swaps and futures. Because these contracts involve buying and selling future risks without underlying assets, they violate the strict prohibition on gharar. The solution came through the ISDA-IFM Tawawut Master Agreement. It is a globally standardized framework that allows Islamic institutions to hedge their exposure legally. Instead of trading speculative contracts, the agreement relies on a unilateral promise, or WAD, to execute a future murabaha, a cost-plus sale backed by a physical commodity like metal. By executing actual transactions of tangible goods over time, institutions synthetically mirror the risk protection of a conventional swap, ensuring stability without gambling. Islamic finance operates as a rule-based economic system where ethical requirements dictate the mechanics of market participation. It mandates a shift from debt to equity, requiring that capital generation be linked to the creation of tangible goods in the real economy. The strict quantitative limits on debt, the insistence on true possession, the mathematical precision of dividend purification, and the Tahawut hedging agreement all serve one function: stripping the casino out of capital markets. These methodologies demonstrate that global financial networks can be engineered to serve ancient, immutable principles of fairness and shared risk.